Morning, everyone. Welcome to today's webinar. I'm Linsin, your consumer and healthcare analyst. Yep. So today's session will be a quite long one. I will be giving an update on OSIM, followed by Dehong on first REIT, and Richard on SMRT. Then Peter will be giving an in-depth analysis on the hospitality sector. Without further ado, let's move on. Yep. So for OSIM, as you can see that for this third quarter its profitability is relatively quite weak. The management attributed the weak sales on weak demand due to slowdown, the regional slowdown, as well as the currency market turmoil. Just to give you the trend, so this actually shows you a sign of relief somewhat, where the pace of contraction is actually slowing down. So the profitability is also weighed by their startup and as well as operational costs in TWGT business and its legal fees as well. So its legal fees in the third quarter actually spiked up to 4 million from the first half 3 million, so giving a total of 7 million up to 9 months 2015. So what to expect? The management actually guided that the legal burden would moderate, and they have a good feel that it should be able to end in quite soon. And also they will continue to focus on their TWGT businesses. They'll continue to expand their stores, 2 more in Macau and 1 more in Hong Kong this coming fourth quarter, so pushing up the total store counts for TWGT business to 52 by end of the year. And they are also expecting a pickup in the Hong Kong market. And with that in mind, the store rationalization plan remains intact for OSIM as a whole. And for their OSIM's store counts, they are continuing to rationalize on underperforming stores, especially in China. And for the GNC side, they actually closed 6 stores last quarter, mainly in the Malaysia end. In view of the cloudy outlook, as we expect currency market to remain volatile throughout into 2016, as US Fed is going to raise their interest rate soon. We downgraded our ratings to neutral on OSIM and lower our target price to 1.44. With that, I would like to pass on the presentation to Dehong on first REIT.
Hi guys, good morning. Dehong here. So I'd just like to do a quick update on first REIT because last week there were several comments which appeared in newspaper articles. So this Lippo group, the parent of first REIT, he was quoted on Business Times on Wednesday saying that he plans to move his two REIT listings in Singapore back to Indonesia. So the 2 REITs under Lippo Group are First REIT and Lippo Malls, the Indonesia Retail Trust. So the rationale of this move and what comes behind this is that last week the finance minister for Indonesia actually commented that they plan to introduce tax incentives for companies, and primarily they are targeting REITs, the REIT sector as a whole as well, because they want to boost the REIT listing market in Indonesia. So what they want to try to do is actually they want to introduce tax incentives. They want to do away with taxes for dividends for REITs. So currently, First REIT, are charged a 10% withholding tax for all the dividends that they repatriate back to Singapore, back to Singapore from Indonesia. So this 10% tax would have been saved if they were to be listing in Indonesia instead. So on the back of this proposed measures introduced by the finance minister, the Lippo Group CEO was quoted as saying that he has plans to move his two REITs back to Indonesia. So what we think is that while it's reported to be like that, there are implications involved if he were to really carry out such a move. So firstly, for First REIT, their hospital leases in Indonesia, the rental agreements are all structured such that the rentals are all collected in Sing dollars. And this idea was actually mooted or introduced when First REIT did the IPO. The idea was introduced because as a listing in Singapore, you are targeting investors in Singapore. So when they introduced these rental agreements in Sing dollars, what they were effectively trying to do is that they were trying to reduce the foreign exchange risk for investors over here. Because if you were to be collecting rentals in rupiah and you are investing in Sing dollars, then you have this forex risk, right? If your rupiah depreciates against your Sing dollars. So at the start, they had this initiative is to lessen the forex exposure for investors. So now if you were to move your listing back to Indonesia again, then the entire rental agreements for all your Indonesian hospitals is going to potentially they have to be shifted back to some Indonesian rupiah structure again, which is going to be a very tedious job. Then secondly, what we heard are comments from the finance minister. This actually follows a series of changes and initiatives that the government has actually introduced in a bid to spur growth because of the lackluster growth we've seen in Indonesia. So that being said, right, the comments were made last week, but actual implementation could take time. This can take months, this can take years, and whether or not it's going to be introduced in the very near future is a question mark. So we think that even though the finance minister has committed and has made such a comment, there are and there will be policy implementation risks involved in such a scenario. Then thirdly, the listing in Singapore, and because now rental agreements are all in Sing dollars, valuations of the properties are in Sing dollars. So First REIT actually is borrowing in primarily Sing dollar terms currently. So if you're looking at a listing in Singapore, you're looking at borrowing costs in Sing dollars, you're actually looking at more you're looking at lower borrowing costs or more stable borrowing costs compared to if you were to move back to Indonesia. Firstly, funding cost is higher, and then you have a less stable market because the Singapore market, as we all know, right, the Singapore REIT market especially is a very mature REIT market now. We have grown from our first listing in 2002, Capital Mall Trust. First listing then, more than 10 years ago until now, we have grown by leaps and bounds. We have grown to like almost a $69 billion market cap REIT market. So this massive REIT market in Asia, we are only second behind Japan. This massive REIT market is actually provides the companies listing here easy access to institutional investors, easy access to funding, because as a listing in Singapore, you're able to attract investors because you have a very stable government, you have a very stable government policies, and you have very stable Sing dollars as well. And this cannot be said to be the same if you were to move the listing back to Indonesia. And currently, Indonesia's market, they only have one REIT listing. It's still a very, very young market in its very early stages of infancy. Then lastly, for First REIT, the shareholding structure is actually very fragmented. Apart from the parent, Lippo Karawaci, which owns about 27%, the second insti owner owns about 5 to 6%. Apart from these two, the other shareholders, the next biggest shareholder, they all own less than 2% of the shares. So you're looking at a very fragmented shareholder structure as compared to few majority shareholders. So a move of the listing back to Indonesia would involve a delisting, which would actually mean that you have to convince a broad spectrum of investors, which means that you have to come out with a very compelling takeover price. And we think that having such a fragmented shareholding structure, carrying out a delisting would not come as easy as thought to be. So that being said, we have listed several hurdles to if management wants to shift listing back to Indonesia. But that being said, because because of the potential incentives that the government is going to introduce in Indonesia to accommodate a more favorable and attractive REIT market in that country, we actually think that there are risks to our investment thesis in that. Now, if you look at the more easy listing market over there, right, it actually presents the Lippo Group and Lippo Karawaci, which is First REIT's parent, better, or you can say more options if they want to recycle capital. They have a portfolio of hospitals under them, still not injected into the REITs yet. So if they were to be presented with more options for them to recycle capital, then chances of them injecting hospitals into First REIT could slow down. So we're looking at a potential slowdown in the injection of assets into First REIT should all these measures come into place. But then that being said, in view of all the hurdles that we have mentioned, if the parent wants to shift the listing back to Indonesia, we think that the shift is actually not very possible. And with that, we actually maintain our accumulate call on the stock, and we have a target price of 149 as of now. So to combine fundamental analysis with technicals, we have actually come up with this TA chart, which is available on our Monday morning note today as well. And then basically you can view more details from the morning note, because that morning note will actually have the daily chart. What I'm showing now is the weekly chart. So the daily chart will have more responsive, actionable plans for people who want to trade the stock short term. So primarily what happens here is that we are seeing a very strong support at the 115 level. It's reached that level and rebounded when we came down in August, and it's reached that level and rebounded again last Friday. So next I'll pass on to Richard to talk about SMRT's results.
Hi, good morning. This is Richard speaking. Okay, so this is a snapshot of the results for the various business segments of SMRT. It's a bit messy, so I'll just go through it maybe line by line. So this is for MRT, LRT, and bus. For this quarter, the revenue was up due to higher ridership and average fare. Taxi business also up 7.1% year-on-year due to larger and newer fleet. Rental also up, contribution from Kallang Wave Mall, advertising up due to increased advertising on trains and buses. Engineering services was down 4.2%. This was due to completion of overseas consultancy project, and which did not contribute in this quarter. And lastly, other services was also up due to higher charter revenue. So you can see one quick glance here, revenue for the quarter for each of their business segment was generally up except for one, and consequently revenue at the group level up 4.7%. So broad-based growth across most of the segments. Okay, same as last quarter. MRT, LRT not profitable. For MRT is their third consecutive quarterly loss. LRT, there was higher expenses due to addition of new trains to the fleet that resulted in higher expenses for maintenance as well. Bus, on the other hand, was profitable in this quarter compared to the same quarter a year ago. This is actually their third consecutive quarterly profit. So everything else, the EBIT there was EBIT growth, taxi, rental, and advertising, other services as well. One thing I'll point out here is that, which I'll come back to again, but I point out here, if you look at the MRT revenue, 170 million, MRT revenue currently now is more than half of the whole group revenue, and yet MRT is actually not profitable. So quite a lot of the revenue is being wiped out at the group level already due to this unprofitable business segment. The other thing to note is their associate called Shenzhen Zona is a small contribution, but that contributed to some increase in PATMI as well for them in this quarter. Shenzhen Zona is a transportation company based in Shenzhen that has bus service and car rental. Okay, this table basically condenses the previous table into fair business and non-fair business. So you can see that the fair business was up in terms of revenue 3.1%. Largely is due to high ridership and average fare. Non-fair business revenue was up 9% in the quarter. So as I mentioned earlier, group revenue was up due to broad-based growth across most of the segments, except the one just now which I pointed out, engineering services here. But then at the EBIT level, fair business saw its third consecutive quarterly loss. This was due to MRT and LRT, but slightly offset by the profitable bus business. But still, on aggregate, it was loss-making all together. Non-fair business, EBIT was up 22%. This was due to improved profitability from taxi, rental, and advertising segments. And so I went through this just now. Group PATMI was up 1.9% year on year. Okay, so now we go to the bullet points. So the key thing that caught everybody's attention this time round was that SMRT said that they are expecting the rail expenses to increase further. So they actually clarified that for repair and maintenance expense for rail related, it actually includes staff costs as well, or rather maintenance related expenses has two components, the staff cost and the repair and maintenance line item. These two line items appear in the P&L as separate items, but these two actually are the components for maintenance related expenses. And so for second quarter this year, this rail maintenance related expenses took up 41% of their rail revenue, and the management guided that this will actually rise up to 50% from 3Q onwards. Okay, so now I'll go through a bit of a back of the envelope calculation. If you look at this 2Q FY16 rail revenue, it was 172 million. If expenses rise by 9 percentage points, that would translate into a erosion of 5.5 million of EBIT. So let's look at this first 6 months. First 6 months of EBIT, 60 million here. If you were to do a back of the envelope calculation, multiplied by 2, you'll be looking at about 120 million EBIT for the full year. But after that, you subtract 31 million of this EBIT erosion, you'll be left with about 90 million of EBIT. So from there, you can see that if you get a full year EBIT of 90 million and the first half year is already 60, the second half will be the performance in the second half will be significantly poorer than the first half year. So the key factor now for SMRT is that their largest revenue contributor, which is the rail business, is actually being squeezed from both ends, and you can expect the losses in the rail business to continue. So in December 5th, 2015 this year, there's going to be a 1.9% fare reduction, and that will coincide with the opening of Downtown Line 2. And as you may have seen in the map, in one of our previous reports, Downtown Line 2 actually runs parallel to a certain section of the north, south, east, west line. So there's a risk that there'll be ridership cannibalization, as in passengers would choose to take Downtown Line 2 there'll be certain passengers who would be taking Downtown Line 2 instead of the north, south, east, west line. Second, this bullet point, higher rail maintenance related expenses will compress margins. I've already explained just now on the back of the envelope calculation. So there'll be a weaker second half for FY16 for SMRT. And based on this increase in expenses by 9 percentage points, we are estimating that the real EBIT loss in 3Q and 4Q of FY16 will be in excess of 10 million each. Okay, so to conclude, we actually downgraded SMRT to a sell rating with a new lower target price of $1.11. It closed at $1.46 last Friday. Okay, now we move on to the next part of the presentation.
Good morning, everyone. Thanks for tuning in. This is a sector update on the hospitality sector. We revised our view and think that the worst is actually over already. And if you look at it, international visitor arrivals, it came in very strong in July and August, surprisingly strong in fact. In July, it reached an all-time high of 1.52 billion. This compares to the previous high of 1.48 billion in August 2013. While we think that the year-on-year growth in September would be a continuation of the momentum, we still expect a one-on-one decline. That means from August to September, we still expect a decline in visitor arrivals. Next, this visitor arrival growth was driven by an increase in Chinese visitors. In July itself, we saw a 13.7% increase, and in August there was a 19.3% increase. In August 2015, total visitor arrivals grew by 81,000, and within this 81,000 of growth, just by Chinese visitors, there were already 93,000. And how is that possible? Because the rest of the markets have actually declined, in particular to Indonesian visitors. And this is the market share of of visitor arrivals coming to Singapore. There's no change in it. So for the first 8 months in 2015, the largest arrivals comes from Indonesia, followed by China, Malaysia, India, and Australia. And the growth in Chinese and Indian visitors, we saw a 19.4% as well as a 7.3% year-on-year increase respectively. This implies that market share is growing, and we attribute the growth to the strengthening of their domestic currencies against the Singapore dollars. There is a relationship between visitor arrivals and the domestic currencies against the SGD, and so I'll just bring attention to China. We see that there's a depreciation in the Singapore dollars, and hence it could be a reason why more of them are coming here. Similarly, it applies the same for India. we see that visitor arrivals are rebounding, and I'll just remind everyone that we had 5 consecutive quarters of visitor arrivals falling, starting from March 2014, ever since the MH370 incident. But then again, this rate of decline has begun to ease, and we see signs of growth resuming again, based on two things that I've shared already previously, and the first is uh, July visitor arrivals has hit a record high, followed by uh, followed by we we would like to see uh, for this rebound to at least carry on. We would like to see 1 quarter of year-on-year growth as a signal, followed by a second consecutive quarter of growth in order to confirm whether is the rebound sustainable. And if you look at it, for the past 20 years, there were 3 periods when visitor arrivals took a hit. That was during the Asian financial crisis in 97-98 period, um, the SARS outbreak period during 2003, and the global financial crisis in 2009. And the table shows the visitor arrivals. It's a summary of the visitor arrival performance of it since the three crises. For Asian financial crisis, we see 5 quarters of consecutive declines before an increase in the first quarter of '99. Similarly, for SARS, there was 4 quarters. For Lehman, another 4 quarters. So right now, interestingly, um, from ever since the MH370 incident, we've really seen 5 quarters of decline. So we think that going forward in 3Q and 4Q, we should see some form of rebound, but that's just based on historical. Data, and we think that's not good enough. We'll show you why in a while. So what we've done next is to create our own scenario analysis. Just bring everyone's attention to the third table here. So even on the extremely bad case scenario, even if visitor arrivals in September, even if it falls 12%, we'll still see a 3Q, we'll still see a 1.6% year-on-year growth on 3Q, because at this point of time, the STB, or Singapore Tourism Board, hasn't published data for September arrivals yet. And we think that going forward, even in 3Q, 4Q, we think that arrivals will be strong because of the pack of events that is lined up for in Singapore. So if you look at the table here, almost every single month there's a blockbuster one. In September, we all know there was a F1 night race. In November, which is going on right now, there's a WTA finals. And in December, Roger Federer is going to come to Singapore and he's going to play in the International Premier Tennis League. Well, as much as we remain optimistic that visitor arrivals will carry on the growth, but we note that this growth has not been a broad-based growth. What do I mean by this is that the Indonesian, Malaysian, and Australians visitors haven't been growing. So we would like to see a broader-based growth, or at least 2 consecutive quarters of growth of between 4 to 6%, in order to say that the growth or the rebound is sustainable. Okay, this is just some observations that I've made based on the expenditure of tourists when they enter Singapore. And in 2014 itself, total receipts were 17.7 billion. And we've noticed that Indonesian and Chinese visitors, they are the biggest spenders. Next, the Chinese and Indian visitors are the two high growth markets. And for these two demographics, the Chinese people tend to spend more on shopping, while the Indian tourists, they spend more on accommodation. This is a graphical representation. You can have a look at yourself later on. Then next, we look into the Singapore hotel operating statistics. Average occupancy rate in August was much higher, or 1.5 percentage point compared to the previous high of 90.6% in August 2014. And we think that the SG50 celebrations were effective in drawing visitors. So on an 8-month adjusted basis now, average occupancy rate is down 0.6 percentage point. And the gap between the 8th month in 2014 is already closing. Next, we look at average room rate. While we saw that there's a 13th consecutive month of decline, but we think that this is because of the high or relatively strong SGD, which has made people switch their consumption. That means that when they come to Singapore, they apologies, uh, they go for the slightly lower tier rooms, which are the mid and economy rooms. And these rooms, they command a lower average room rate. Therefore, we see lower ARR because of this. And on the 8th month, on the 8th month basis, ARR was down 5.4% to $243 from $256.80. Next, we have RevPAR. So this revenue per available room, or RevPAR, is a function of ARR and AOR. And RevPAR was down mainly because of the lower average room rate. Even though there was much better visitor arrivals as well as higher occupancy rate. And in summary, RevPAR was down 6% year on year to $207.30 from $220.60 in 8M14. Now, this is an outlook for the hotel room supply demand in Singapore. And according to Hospitality as REITs, hotel room supply is estimated to grow at a CAGR of between 5.9% sorry, and 6.6% over the next 3 years. And then again, IVA has been historically growing and at a 10-year CAGR of 6.1%. These two numbers are already coming to the matching level. And what does this mean? It just means that the growth in visitor arrivals is able to absorb the new rooms which are coming online if growth carries on to if visitor arrivals, the growth in visitor arrivals carry on to be like this, carry on to be strong, I mean. And these are some recent developments in the sector, in the hospitality sector. Airbnb is in negotiations or in talks with URA, and we think that if they are be formally allowed to operate in Singapore, it could become a market disruptor, especially to the hoteliers. And next is the Singapore Tourism Board continues to go on an advertising campaign. This time round, they went to China. They signed 6 memoranda of understandings with 6 Chinese media firms in a bid to attract more Chinese visitors to come to Singapore. Lastly, we have some investment ideas. And if visitor arrivals is to carry on growing, we think that this will be a boost to hospitality and the hospitality and gaming sector, especially Genting SP, Hospitality REITs, OE Hospitality Trust, and Vice Hospitality Trust. These two trusts have their portfolio, all their assets are in Singapore itself. And lastly, it will also be a boost to the retail REITs, the SPH REIT and STAR Global REIT, simply because their properties are located at the Orchard Belt. And we come to the end of our webinar, so feel free to ask any questions you may have.
Okay, we'll wait for 1 more minute for questions to come in. Hi, there's a question on whether we have any comments on the IPO for Jumbo. Okay, for this IPO, actually we are currently working on a note uh, for it, so probably will come out within the next 2 days or so. So please look out for it. And if you are a client, you can download it from the Poem's portal. Hi, there's a question on the what is the view on the 4-year Oxley Holdings retail bond. We do not cover fixed income, so we are not licensed to comment on bond. Okay, since there are no further questions, we are going to end the webinar now. Please tune in again next week.